Someone you know made money off Bitcoin. You watched it happen and did nothing. You saw the price go from nothing to $69,000 and told yourself you'd buy in once you understood it enough to feel confident. You never got there. You never bought. And if someone asked you right now to explain what Bitcoin actually is, why the price moves the way it does, or what's actually happening when the whole thing collapses, you'd have nothing. 80% of retail crypto investors lose money because they bought first and tried to understand second. That's not a luck problem. That's an explanation problem. This video fixes that. Before anything else, here's one thing to hold on to. Bitcoin has a rule coded directly into its original software. It's been there since day one, and most people who lose money in this market have never heard of it before. They're already down. It controls how much Bitcoin will ever exist, and it has driven every major price cycle in Bitcoin's history. We'll get there. But first, everything else you need to understand. Banks have been the middleman in every financial transaction for centuries. Every wire transfer, every international payment, every time money moves between accounts digitally, a bank sits in the middle taking a fee and deciding whether to approve it. Send $200 overseas and you might pay $15 in fees and wait 3 business days. The bank approves it. The bank moves it. The bank can freeze it at any time and for any reason. Cryptocurrency removes the bank. Here's what cryptocurrency is: a digital asset where math verifies ownership and processes transactions instead of an institution. No bank, no government, no approval process. The code enforces the rules the same way for every participant without exception. This matters because money has always needed a trusted middleman. Digital money doesn't move on its own, and someone has to confirm a transaction happened and that you didn't already spend that same dollar somewhere else. For centuries, that was a bank. Crypto replaces the bank with mathematics. Bitcoin was created in 2009 by someone using the name Satoshi Nakamoto. Nobody knows who Satoshi actually is. No name, no institution, no permission needed. Just a wallet address and a key that nobody else has. The key point is this: cryptocurrency is peer-to-peer digital money, where code does what banks used to do. No middleman, no gatekeeper, no single point of failure. But if you remove the bank, something still has to keep the record of who owns what transactions happened, and what balances exist. That's what blockchain handles. Every time someone sends Bitcoin, that transaction gets broadcast to a global network of computers. Those computers verify that the sender has the Bitcoin they're trying to move and that they haven't already spent it. Valid transactions get grouped into a block, and that block gets added to a chain, stretching back to the very first Bitcoin transaction in 2009. Here's what makes it impossible to alter. Every block contains a cryptographic fingerprint of the block before it. Change anything in an older block, even one character, and that fingerprint breaks, which invalidates the next block, which invalidates every block after it. The chain collapses from that point forward, and there is no way to quietly patch it. A transaction from 4 years ago is sitting inside a block with thousands of blocks sealed on top of it. Someone says it never happened, but every computer on the network has the exact same permanent record simultaneously. It's not stored in any one place anyone controls. It's everywhere at once. The key point is this: blockchain is a public ledger that exists on thousands of computers around the world at the same time. Nobody owns it, and nobody can change what's already in it. But there's still a question worth asking. If anyone can add to this ledger, who stops someone from submitting transactions that never actually happened? That's what mining is for. The computers that verify transactions are called miners. To add a new block to the chain, a miner has to solve a computational puzzle, a brute force guessing puzzle where the computer tries billions of random answers per second until it lands on the right one. The first miner to solve it gets to add the block and earns newly created Bitcoin as a reward. Here's the part that actually makes it secure. To go back and change a transaction that already happened, you need to redo that puzzle for that block and every block that came after it, and you'd need to do it faster than the entire rest of the network is currently building new ones. In 2023, the Bitcoin network was running at a computational rate that would cost billions of dollars per hour to replicate. Cheating isn't just difficult, it's not financially worth it. Therefore, the network doesn't need anyone to be honest. It needs dishonesty to cost more than it could possibly earn. That's the entire design. The key point is this: mining is what keeps the ledger honest. Computation cost replaces institutional authority, and the rules hold because breaking them isn't worth it. But protecting the ledger is only half the system. The other half is how you actually hold what you own. And this is where most people lose real money. A crypto wallet does not store your cryptocurrency. Read that again, because most people have this completely backwards. Your coins are not in the wallet. They live on the blockchain. The blockchain has a permanent record of every address and every balance. And what your wallet stores is a private key. A private key is a string of characters that proves you are the authorized owner of a specific blockchain address. Whoever has the key controls the address, and whoever controls the address can move everything in it. James Howells is a man in Wales who threw away a hard drive by accident in 2013. That drive contained the private key to a wallet holding $7 7,500 Bitcoin. And at peak prices, that drive was worth over $500 million. It is in a landfill. He has spent years petitioning the local council for permission to excavate it, and they keep refusing. The coins are not gone. They're still on the blockchain right where they've always been. But he can't access them because the key no longer exists anywhere. There is no forgot my password option, no account recovery, no customer support line you can call. This isn't a design flaw. It is the design. The same feature that means no institution can freeze your funds also means no one can hand you back access if you lose it. The key point is this: the private key is the ownership, not the exchange login, not the username, the key. Lose it and the coins are unreachable forever. But knowing how to hold crypto only matters if you understand what you're holding. And the crypto market has over 20,000 assets, most of which are worthless. The second largest cryptocurrency is Ethereum. Ethereum didn't copy Bitcoin's model. It added something Bitcoin can't do: smart contracts. A smart contract is code that lives on the blockchain and runs automatically when its conditions are met. No lawyers, no escrow, no trust required between parties. If condition X is satisfied, outcome Y happens. And it's guaranteed by code that anyone can verify. Think of a vending machine. You put in the money, press the button, and get the item. You're not trusting the machine because the rules are built into the mechanism. Smart contracts work exactly the same way. Two parties agree on terms, the contract gets deployed on the blockchain, and it executes exactly as written the moment the conditions are met. Nobody can interfere once it's running. This is the foundation for decentralized finance, digital asset ownership, and a generation of applications still being built. But not every altcoin is building something real. In 2017, a project called BitConnect raised $2.6 billion from retail investors by promising monthly returns of 40%. It was a Ponzi scheme that collapsed within months, and every investor lost essentially everything. This happened in full public view on a transparent blockchain, with thousands of YouTube creators promoting it right up until the day it went to zero. There are over 20,000 cryptocurrencies right now, and most have no product, no users, and no reason for the price to go up, except that someone is actively promoting them to people who don't know better. The key point is this: the altcoin market ranges from real infrastructure that changes how contracts and ownership work to documented fraud with a logo and a website. Price going up proves nothing, so know what the project actually does before putting money in. But even understanding a project won't help if you're completely misreading how big it actually is. And most new investors do exactly that because they focus on the wrong number. They see a coin at $0.001 and think it's cheap. They picture it going to $1 and imagine multiplying their money by 1,000. But that math ignores how market value actually works. Market cap is the number that matters. Market cap equals total coins in circulation times price per coin. A coin at $1 with 1 trillion coins in existence has a $1 trillion market cap. But a coin at $40,000 with 21 million coins has a market cap around $840 billion. The second one is actually smaller. Price per coin alone tells you almost nothing. Look at Shiba Inu. The price looks impossibly cheap because it's expressed as a fraction of a cent. But there are approximately 900 trillion Shiba Inu coins in existence. For Shiba Inu to reach 1 penny per coin, the total market cap would need to be $9 trillion. For it to reach $1, the market cap would have to exceed the entire gross domestic product of the planet. That is not going to happen. This matters because the illusion of a low price is not an accident. Anyone can create a crypto project with any supply they choose. And if you issue a quadrillion tokens at a fraction of a cent, the unit price looks like a deal, even though the market cap is enormous. The key point is this: price per coin is a number without context. Market cap is the real measure, so always check total supply times price before forming any opinion. But market cap still doesn't explain why prices crash 70 or 80% in a single year. And that's the volatility cycle, which is the piece most people are completely unprepared for. In November 2021, Bitcoin hit $69,000. And 12 months later, it was at $15,700, 77% down in 1 year. In traditional markets, a 10% drop is called a correction. But in crypto, 77% is just a cycle. There's no floor under crypto the way there is under stocks. Crypto has no earnings, no dividends, no physical assets, and what holds the price up is collective belief in future value. When that belief shifts, the price goes with it. The cycle runs the same way every time. Price rises, news covers it. Investors who missed the early move start buying near the top, afraid of being left out. Early holders who bought much lower start selling into that demand. Price stalls, momentum breaks. New investors see losses and panic sell. Price accelerates down, price bottoms, then it starts again. An investor put $30,000 into Bitcoin in November 2021 2021 at the peak. And 12 months later, they had about $7,000. They didn't lose because crypto failed. They lost because they bought during maximum greed and sold during maximum panic. And that is the most common version of this story. The key point is this: crypto volatility is not random. It runs on the same emotional cycle every time. And knowing where you are in that cycle before you put money in is the difference between the two outcomes. But underneath that emotional cycle is a supply mechanism. And it's the one most retail investors never learn about. Here's the rule I mentioned at the start. Every time a miner adds a block to the chain, they earn newly created Bitcoin as a reward. When the network launched in 2009, that reward was 50 Bitcoin per block. Coded into Bitcoin's original software is one rule. Every 210,000 blocks, the reward gets cut in half. This is called the halving. 2012, 50 becomes 25. 2016, 25 becomes 12.5. 2020, 12.5 becomes 6.25. 2024, down to 3.125. There will only ever be 21 million Bitcoin in existence. That cap is in the original code and cannot be changed without the agreement of the entire global network. The halving controls how quickly the remaining supply enters circulation, and each one cuts the rate of new Bitcoin in half, which means every cycle the supply pressure compounds. Apply basic economics. Every 4 years, new supply gets cut in half. If demand stays flat, price pressure moves up. If demand grows, that pressure compounds even further. Bitcoin is not printing money. It is doing the exact opposite. Look at what followed each halving. 2012, Bitcoin went from around $13 to over $1,000 in the 12 months after. 2016, from $650 to nearly $20,000 by 2017. 2020, from $9,000 to $69,000 by November 2021. 3 halvings, 3 bull cycles, each one within 12 to 18 months of the event. That is not a coincidence, because the mechanism is hard-coded and the schedule has been publicly known for years in advance. Every retail investor who bought at $69,000 and sold at $15,000 had the exact same opportunity to understand this before putting $1 in. Most of them never looked it up. The key point is this: the Bitcoin halving is a scheduled, code-enforced supply cut that happens every 4 years and cannot be changed. It has preceded every major bull cycle in Bitcoin's history, and most retail buyers only hear about it after they're already down. Here is what you now know. Crypto replaces institutional trust with math, no bank in the middle, and code enforces the rules the same way for everyone. Blockchain is a permanent public ledger replicated across thousands of computers at once. Once something is recorded, nobody can change it. Mining keeps it honest. The cost of computation makes fraud more expensive than playing by the rules, and that's the design. The private key is your ownership. Lose it and nobody can recover your access. Not ever. Market cap is the real size of an asset. Total coins in circulation times price per coin. Never judge from unit price alone. Volatility in crypto follows the same fear and greed cycle every single time. Most investors enter at the top and exit at the bottom, and knowing the cycle before you enter is the difference. The Bitcoin halving happens every 4 years, cuts new supply in half, and has driven every major bull cycle in Bitcoin's history. If you're going to put money into any of this, know what the project actually does. Check the market cap, not just the price. Know where you are in the halving cycle, and never put in more than you can afford to lose completely. That's not a warning. That is the actual strategy used by the people who don't lose.